Welcome to Strictly Money. I'm your host, Saijal Patel. Talk to anyone these days about the rising cost of living and you'll hear the same frustrations. That their grocery bill is through the roof, that filling up their gas tank is costing them $100 more a month. They worry they'll never be able to afford a home. And renting, well, for many, that's not a cost-effective solution either. This is the reality for many Canadians. They're not imagining things. In fact, the last reading of inflation, also known as the Consumer Price Index, jumped 3.7% compared to a year ago, the biggest rise in a decade, and well above the Bank of Canada's 1% to 2% target range. It's no wonder that inflation is also a hot-button election issue. So, how long can consumers expect to feel the pinch? And is there a way to inflation-proof one's investment portfolio? To answer these questions and much more are Lesley Marks, Chief Investment Officer at Mackenzie Investments, and Martin Lefebvre, CIO, National Bank Investments. Welcome to you both.
Hi, pleasure to be with you.
Martin, in the finance world, we talk numbers, inflation numbers. For the average Canadian, though, what they care about is that every time they pull out their wallet, they're spending more and getting less in return. So how long can Canadians expect to pay higher than normal prices?
Well, the first thing you need to understand is that the way we measure inflation, it's on an annual basis. So because inflation was so low during the midst of the pandemics, in a deflationary environment, now we're feeling the brunt of that. So it's mainly base effects, and that will go away surely over the next couple of quarters as we just move along. And part of this spike in inflation is also related to energy prices that went from extremely low to a big jump following that. So you're right, the gas tank, whenever, and it's 10% of the inflation basket, but it represents 90% of the fluctuation. So whenever energy prices go up, we kind of see it right away. But the way we like to measure inflation is more on the underlying side of the economy, and that's measured through what we call a core measure, which excludes energy prices and food. And that has also gone up over the course of the past couple of months, mainly because there's supply disruptions around the globe that's exerted a tremendous amount of pressure on semiconductors, just to mention that one in the US, had a huge impact on the new car productions, and as such, people have reverted back to the used cars and used trucks for as an alternative. And what we saw is that trucks and used cars in the US have gone up at a pace of 10% over the past 3 months. So that's unsustainable, obviously, at that pace. Used cars will be more expensive than new cars in no time, which doesn't make any sense. The same was, we saw the same thing with hotels and airfares, which went from a complete lockdown period where prices were nowhere to be seen to going back to normal. And that's what the inflation basket is kind of measuring right now. So we kind of feel that it's transitory in nature. And as soon as we go back to normal, things should go back towards the central bank's target of around 2.5% in no time.
Lesley, how is the stock market then pricing in inflation?
Well, I think that the stock market is also taking its cues from the central bankers as well as the bond markets, which are really reflecting that transitory nature that Martin referred to. I think if we thought that inflation was going to be sustained at extremely high levels on a broad basis and not sort of hot spots here and there, then I think we would see much more of a focus on a reflation trade. We did see that in the early stages of recovery towards the end of last year and early this year, but now the market recovery or upside in stocks has been much more reflected in the growth side.
Lesley, we have about 45 seconds before the commercial break. Are there sectors that you're seeing that are benefiting from inflation?
The sectors that benefit, I mean, the number one is the commodity sector. So where you have strong commodity prices, you have strong pricing power. Other sectors that would benefit are the financials, where you would see movement upward in interest rates. That usually helps most financial services companies. So those would be the two that come to mind.
Okay, and some great points there. We're going to continue this conversation after the commercial break because I want to get your take on portfolios and how you manage those. We'll be right back. Martin, I'm going to put you on the spot here. Do you think that the central bank is doing enough to manage inflation? And is there anything else that you would want to see to manage it better?
Yeah, first of all, very good question. But first of all, it was clearly a non-event, very well telegraphed and well expected by market participants as well. But because of the nature of the inflation that we're seeing right now, there's nothing really that the central bank can do. It's not a matter of the economic cycle where we are in the economic cycle. It's really the supply disruptions. And really, central bankers don't have much grasp on that. Even if they lower interest rate or raise interest rates, it's not going to have any impact on labor shortages, to mention that. So I don't think that they can do much more at this time. What they're saying is giving us forward guidance that they're willing to tolerate a little bit stronger inflation in the short term, but eventually they've telegraphed that very well, that somewhere in the second half of next year, 2022, that they might be willing to start increasing interest rates. So there's plenty of time before interest rates start raising.
Okay. Lesley, I want to ask you about managing one's portfolio and trying to inflation-proof their portfolio. So one of the scenarios may be that someone is mostly in equities. Typically, that's a younger person with higher risk tolerance. So how do they inflation-proof their portfolio?
Well, I think first of all, you have to think about the context around inflation, and is that inflation driven by economic growth? So in the scenario that we're seeing today, I mean, a lot of this is very much related to a post-pandemic recovery. So it's a bit of a unique situation. But generally, the inflation is related to that recovery, but also supply constraints that were caused during the lockdowns during the pandemic. So that's why we generally view inflation as transitory. So when you think about inflation proofing, that sort of implies what you would do if you thought that inflation was going to be sustained. And so we have to think about that in the context of how you position your portfolio. But if you're worried about runaway inflation, as we talked about in the earlier segment, there are some natural places that you would be allocating towards when it comes to sectors, one being commodities. And we didn't get into specific commodities, but there are some that are more demand and supply driven, such as energy commodities, base metals. And then there are other commodities like gold that are generally thought of as stores of value and that do well in inflationary environments. So equity investors would definitely be focused on commodities. They would also be looking at companies specifically that have pricing power, where demand is not really responding negatively to higher prices. And one example of that would be in travel and leisure right now, because as we all know and feel, there is this hunger to get out and do things and to travel post-pandemic. And so that's an industry that will have much more pricing power than it probably has in other economic recoveries. And so those types of companies should do well in an inflationary environment.
Okay. Yeah, it's interesting because I've been reading a lot about shrinkflation as well, and how companies are charging the same prices. This is usually consumer staples and actually shrinking the packaging. Martin, I wanted to ask you about portfolio management as well, because for those who probably, say they have more fixed income exposure. I mean, this is a real issue because if you look at real interest rates and you take inflation into account, sometimes that return is actually negative. So what's your take on that? How does someone, inflation-proof that side of the portfolio?
Yeah, you're right, Saijal. You have to factor in the fact that there's going to be perhaps more inflation, but also that interest rates at a very low level to start with. And that's basically 95% of your forward returns looking ahead. So for us, we're telling clients, and we're going to be publishing our long-term market expectations early next week. And we'll probably have a lot more to say about this when we do. But in a nutshell, we're expecting interest rates to central banks will start increasing interest rates somewhere over the course of the next couple of years, and as such, it's going to exert upward pressure on long-term bond yields, and because of that, bonds are becoming riskier. So low yields, long duration, so the sensitivity of a bond is at the highest level ever seen. So it means that even the slightest of increase in interest rate will exert downward pressure on bondholders, and that's somewhat of an issue for us.
Okay, well, we'll have to leave it there. I really appreciate your time today. Lesley Marks and Martin Lefebvre. Welcome back. Well, prices for everything from gas to groceries have skyrocketed, causing financial strain for millions of Canadians. Joining me now with her insights and advice on how to make your dollar stretch and outsmart inflation is Stacey Yanchuk-Oleksy, CEO of Credit Counseling Canada. Stacey, it's great to have you on the show today.
Thank you. Good morning.
Now, Credit Counseling Canada, they commissioned a survey very recently, and they were asking Canadians about their financial health and the impact of inflation. What did you find?
Yeah, it was really interesting. So what we found is that the two leading factors for consumers measuring their financial health are stability as well as living within my means. So we can see that the cost of living actually impacts people and their finances.
So where are they finding the issue when it comes to inflation? Is it housing? Is it gas? Is it something else?
Oh, absolutely. I mean, we can all think about how we've spent our money over the last 18 months, like the grocery store. We're definitely noticing, prices are more expensive. I mean, even a head of cauliflower, it's not covered in chocolate, but it's expensive, and we're noticing it at the gas pumps as well. Gas is not cheap. Housing costs have certainly gone up. And even, because people are spending more time at home, they're having to spend more money. They're doing more home improvements or solo activities. So we're seeing the costs of those go up as well.
When it comes to housing, are you finding that people are concerned about paying their mortgages, for example, or is it rent or is it something else?
It depends on the consumer, but yes, I would say that some are definitely concerned about how to afford, be it rent or the mortgage. And, even if you get into the mortgage and you can afford the payment, let's not forget that sometimes things break down, right? Or you have to pay for your insurance or your taxes. So those added costs start to put that pressure on consumers, who are living in costly homes.
Yeah. Stacey, what's changed from what you can see when it comes to savings habits and debt habits pre-COVID and then I guess you can call it post-COVID?
Right. I would say with before COVID, I mean, we had different levels of savings, of course. What we've noticed with COVID is that some Canadians, like some folks in Canada, have done really well. They've been able to work from home, save some money, and actually pay down some debt. But that's some Canadians. That's not all. And some Canadians have actually really struggled with it. Their employment has been impacted, so their household income has been impacted. Their stress has been impacted. And of course, their finances have been impacted considerably. And so it's creating a lot of stress for some people.
Who is typically coming to seek your help when it comes to, credit and debt management? And has that changed because of COVID?
Right. Honestly, Saijal, it's everyone. People think that income is associated with debt stress or whatnot. It has nothing to do with it. In fact, we see people, with low incomes. We see people with, average middle class incomes, and we see folks with high incomes as well, because income does not dictate how you handle your money. It just dictates your income. So it's quite fascinating to see how many people we see and different walks of life coming in. And I don't think that's shifted so much with COVID.
Yeah. So when someone comes to you and your team and says, you know what, I'm really struggling. I don't know how to pay my debt. I don't know how to manage expenses. What do you advise them? Walk us through that process.
Absolutely. So what our members do, so our credit counselors, who are member associate or member agencies, what they do is they first meet that client with a deep amount of compassion and empathy. And I think that's really important to emphasize that, first of all, that consumer gets reminded that they're not alone. We've associated net worth with self-worth and we've enmeshed them together, and they're actually completely separate. You can be broke and be a great person. You can be rich and be a great person as well. Money's not relevant to your worthiness, but we've associated that. And so people feel shame. And when they feel shame, they don't reach out for help. So our credit counselors, what they do is they first show up and they say, you know what, you're not alone. We got you. We can help you. And then we get into the practical aspects of it. When I had the privilege of meeting with clients as a credit counselor, I would look at their whole financial situation, like really all the numbers, the income, the assets, the liabilities, all the monthly expenses, not just the ones, the 4 or 5 that we keep in our head, but like, the 2 pages worth of monthly expenses. And then I look at the debts. And with all that information, what we can do is actually just lay out some options. So what that consumer does is they walk away with a plan of action. So they come in really, really stressed. They walk away calmer, feeling like they're not alone, and they come away with a plan. That's what our members can do for them.
All right. Well, that's great. A lot of good points there. Stay with us, because when we come back, we're going to talk about the impact that inflation has on credit. Stay with us. Well, welcome back. Stacey, with this rise in inflation and cost of living, what have you seen in terms of people's dependence on debt?
Sure. So, some people have actually paid some debt down. As I was mentioning earlier, some Canadians have actually benefited and done well during COVID. So, great for them. Unfortunately, some others have struggled. And that's where, if we see, the cost of living going up, that means my dollar is just not stretching far enough. And so if I have to pay for groceries for my family, or I have to pay for gas to get to work, then, if I don't have the cash for it, or I don't have the savings, I pull out my credit card or I use my line of credit. And so what happens is that, as my dollar doesn't stretch as far, I still have to pay for life. So the credit comes out. And that's what we're seeing.
So how do you help those people when they come to you? What's the first step? Is it consolidating debt? Is it something else?
It entirely depends. So I always say my first step is reminding people that they're not alone. And I keep saying that because it's really important that people feel that they're not alone. And then we look at the numbers, because sometimes consolidation is a good option, and that's where you pool it all into one payment. Obviously, you pay off all your debts, close those down, and then you just have the one payment. Sometimes, consumers can't afford a consolidation loan. So that's where they can look at, what's called a debt management program. And that's where our members can certainly help. And that's where we can consolidate the debt, but the creditors are generous with their interest reduction, so that person can get out of debt in a reasonable amount of time. And sometimes, they have to pursue a legal solution, like a bankruptcy, because things have just gone too far. But what a credit counselor can do is look at all those numbers, because truly the numbers will dictate the solution, and then guide them accordingly.
Stacey, I see so many worrying statistics. The other day, I read that 30% of Canadians say they're insolvent. Another says that Canadians are carrying something like $2.1 trillion in debt, that Canadians have more mortgage debt than ever before. As someone who deals with people that have expense and debt challenges, what's the most concerning to you? And also, what sort of solution would you like to see for us as a society, really, to move forward?
Well, I think my biggest concern for consumers in Canada is debt levels. Again, some have done great with their debts, but a lot have not. And I think we have to remember that while, we can quote stats and numbers on debt, let's translate that down into the personal. That's a person who's deeply in debt and is scared and is feeling ashamed. That's a couple that is fighting at night, maybe in front of the kids or not, about their debt. That's someone who's not sleeping at night. So of course they go to work, not having sleep. They're feeling terrible about things. So is that someone as productive, right? Debt has tremendous impact on people, families, and society. So my biggest concern is the indebtedness and that feeling of hopelessness, like, it's never going to change. Well, we believe that it can change. So I think some solutions, and I say this as a financial educator, so that's really where my heart is.
Yeah.
But I really think that prevention is the key. It's educating kids from beginning, grade 1 all the way up to post-secondary. It's also educating people just in time. As you're about to get a credit card application, let's give you a little bit of education. As you're about to miss a payment, let's nudge you and talk about that and get you some support. And of course, I would always say that, credit counseling is a great service. A nonprofit credit counselor can actually help guide consumers, especially when they're stressed about their money.
Yeah, and certainly professionals, they play a role.
Absolutely. Absolutely. And I think it's important that the professionals in our life, and that goes from doctors, dentists to accountants, everyone sees or recognizes the signs and symptoms of financial distress. Because you can show up to your doctor and go, you know what, my back is really sore and, I can't get rid of this headache. I'm not sleeping and my anxiety is pretty high. And the doctor goes, okay, well, maybe it's anxiety. Actually, maybe it's money.
Yeah.
And if we just peel back the layers a little, we actually know that we learn that it's actually a financial issue.
Yeah.
And financial issues can be solved.
Yeah. We certainly know money is the top source of stress for many people. Well, we really appreciate your time today and your tips. Thanks so much for joining us. That was Stacey Yanchuk-Oleski of Credit Counseling Canada. Well, that wraps up this edition of Strictly Money. Let me leave you with this thought. The direction of our economy is not easy for us to control. Sure, we can vote to hold our leaders accountable. We can also vote with our dollars, but change doesn't happen overnight. What is in our immediate control, though, is financial awareness. When we know better, we make better decisions with our money and with confidence. So stay well, stay wise, and stay wealthy. We'll see you next time.